Hello, folks. Brandon Chapman with you today. It's a Monday night TheoTrade video. Big move today in the market. I say big only because of where we finished. So, for example, last Friday we closed below the low from September 6th, or more importantly, the low from November 1st, which we ended up holding before we rallied over a 4-day period and then faltering last week on the CPI data. Now, as the Fed looms this Wednesday, of course, rallying, the Fed finished at the highs. Fed is announcing on Wednesday, do they spoil the party? And this is a big deal, right? I'm like, the fact of the matter is the Fed is raising very quickly, historically quick. The implications in the economy are definitely rather dire. We have declining GDP outlook for third quarter, which is about to wrap up at the end of the month. We have earnings that are probably still a bit optimistic. Other news out there just looks like we're starting to spin towards recession. So we have to kind of have this kind of balancing act of understanding short-term oversold dynamics and bigger picture bear market and economy. Now, as we look at today's rally, it is certainly optimistic in the near term. As we're finishing near highs, we're finishing kind of near that resistance level. If we take 3,900 out, could we go to 4,000? Pretty readily. In fact, if we kind of measure the retracement here, 4,000 is about the 61% retracement of the sell-off over the last week. So as we look forward, a bounce over the near term probably would be very difficult to carry 4,100 or especially 4,300 given the bearish climate we're in. But as I talked about today in my session, that the near-term dynamics are rather bullish. For example, VIX right now stalling out near highs at 28, probably expecting the VIX to pull back towards this kind of 22, 23 area as a support. And if we find support there, market likely pulls back. If we look at skew, and this is probably one of the more bullish indications, is a skew after popping momentarily on the big sell-off following the CPI print last week has been pulling back, and today stands at around 117. Down at 115 to 120 is that kind of market clearing area. So what does this mean? It means that we're open for a near-term rally in the market. As we look at back to front month volatility, VIX 3M plus VIX, we're trying to identify how much higher is the 3-month VIX over the VIX. You'll notice right here 1.04. Now we're not down below 1 down here, which was more bullish, but we're not above 1.2. What does this mean? Again, we may see a little rally here, and this could quickly reset back to higher levels if a decent sized rally in the coming days happens. Now, obviously the wild card on Wednesday, the Federal Reserve is going to announce their policy statement. 75 basis points is the expectation. And again, but that's baked in the cake. But what about the next report, the next meeting, for example, in November and then December? What's the trajectory right now? So the only bullish kind of silver lining is if the Fed does come out and maybe temper some of those interest rate expectations of 75 in November, 50 basis points in December. Maybe that opens a door for a rally. And again, but that rally only is going to carry it back to where? Well, again, it's probably not going to change the dynamics of where the market's going in the bigger picture. But could we test again? 4,100, 400 here, or possibly even running back to 415, maybe, and that's on the SPY. Now, as we look at the S&P 100 and top performers, and as we look at the top performing sectors on the day, notice here, for example, materials really leading out, followed by cyclicals, industrials, and then utilities. Utilities is interesting given the fact that it is more defensive. Financials in the mix here, staples down a bit, healthcare and REITs bringing up the tail end of things. But you look at the top performing stocks. We've got GM in here. We've got Nike, Apple, DuPont, Nextera is an energy company. Sorry, utilities company. So certainly the near-term potential here for utilities. Nextera may be going from 86, 87 up to 91. The idea being is that, are you betting on GM running to brand new fresh highs, or Nike, a consumer stock, running to brand new fresh highs Or is it probably more likely that something like Nextera would maybe make a run? So I would definitely say that we probably want to skew more defensive. And my point in sharing that is that, yeah, I mean, could the high short interest stocks make a move? Yes. Right? Is it likely? Well, look at it. I mean, last go round, we had 4 updates and then we got hammered on the CPI print. We could easily see another update tomorrow and then get hammered on the Fed statement, or maybe we rally a little bit on the statement and then rip lower by the end of the week or early next week. Point being is that sometimes it's easy to kind of anticipate a move. Sometimes it's hard to take the profits off the table when things turn very, very quickly. So for this rally, I think it's probably reasonable, similar to last week, to potentially, or 2 weeks ago rather, to be in a position of looking for defensive-oriented stocks predominantly. Again, a Nextera is an example of a top performer today, and we'll look at a couple of others that have had unusual option activity. We look at /GC. We're looking at gold. Gold basically finished flat on the session. You can use GLD as a proxy. Again, flat on the session. What's the dollar's next move right now? It looked like last Monday the dollar was poised to slide against the euro as an example. That reversed quickly on Tuesday with the CPI print. It seems like the Fed's pivot from raising rates to cutting rates is now mucked up. It's going to be very, very hard for them to start to cut rates anytime soon. But any silver lining on Wednesday could create a little bit of upward move, but the risk is still to the downside in terms of economically, right? We're continuing to kind of tail towards recession. And again, this bear market is still squarely intact. Does the dollar strengthen? Well, if it does, gold should go down. An interesting trade today in Kinross Gold KGC. KGC was up like 10% today, rat resistance. The interesting trade that was put on was actually out there a little bit. So, for example, on KGC, it was the December expiration. Notice what went on here. This was basically filled almost entirely in one print, 450. Buying the 4, selling 2, 450. What does this mean? If we look at down at the time in sales, what you'll see is this was placed for basically a zero debit. You know, buying that for 22 cents, selling 2 of those for 22 cents, zero debit. And what this means is that essentially we're looking for the stock to be bottled up here, trading through $4 en route to 450. But again, based upon that trade, they don't want it to go above 450. So again, near-term bullish trade on KGC. And you're seeing today's move and volume reflecting it. Again, near-term target is going to be 450. Can we get there? It's going to take some help, obviously, from the Federal Reserve this week. But if their statement yields more of a weaker dollar response because they're hemming and hawing and maybe starting to pull back on some of the bullishness that were conveyed, hawkishness that was conveyed in Jackson Hole, that's the bull case scenario in the near term. So it's certainly reasonable to position for some near-term strength, albeit on a very limited basis. Some other examples here. We look at oil /CL. Finish up modestly. Again, the near-term dynamics right now. Again, we're just seeing that expectations of some demand destruction are there. And you start to look at the curve, you're starting to see it's really flattened out compared to the recent past where it's been a lot steeper at other points. So what we're seeing right now, we're starting to approach or maybe get that S-curve. We're still in backwardation. It's still showing some risk to the upside, but the fading of the bullish and steepness of the curve is certainly starting to call into doubt the potential upside here. So while $80 is probably a pretty good baseline for oil right now anyway, without a stronger dollar and potential potential demand destruction, 80 to 100 certainly seems like a reasonable range unless the dollar really starts to strengthen, and that would generally accompany a major move lower. And a major move lower would also mean what? Generally speaking, treasuries might find a bid. Well, last Friday, it was the October expiration on the call side, buying the 110 and selling the 116. Again, it's a relatively low risk, high reward trade looking for a near-term move in TLT to 116. Again, that probably would happen if what? The Fed is expected to pivot. It's possible that could happen in conjunction with the market rally, but also could happen in a market sell-off, only that people are diminishing the outlook. And this is a 20 to 30-year Treasury bond ETF. So again, I think I kind of like this position being relatively oversold here, but the Fed does create a major wild card. So what does that mean? It probably means you got to stay a little more defensive. So a company like Kroger that's had rising estimates over the last 60, 90 days, you're not seeing the big cuts. It just had its earnings and it fell back again, back to support. Near term, we could reasonably see a rally back towards prior highs at 52. Today it was the October expiration out here at the 49.50 strike. Yeah, it's about $2 above the current price, less than 5%. But if we start to catch a bid here, 49.50 may not be the way station. We could readily see that go to 52, maybe about 10% near-term upside in Kroger for a relatively defensive stock that should, even in a pullback, outperform the S&P 500. Another, sort of defensive. I mean, maybe there is that bit of a trading down in terms of, your eating out preferences. Maybe you're not going to like that real expensive restaurant. You're trading down and maybe even trading down further into McDonald's. And these companies are the last to give up the ghost in terms of people buying stuff. And so as we're looking at Friday and then today's bounce, we saw as a weekly expiration for the 23 SEP. But again, some desire to kind of push this stock at the 260 strike. And so 260s here. Could we catch a near-term bid at 260 this week? Yeah. We might even see more. Again, all depends on what the market does in response to Powell's testimony and the FOMC policy statement. So if things come out more dovish, dollar weakens, we could see these stocks push, in this case, McDonald's push towards 265, maybe even 270 in the near term. On the bearish side of things, though, and this is where, again, you get this juxtaposition of near-term strength, but overall weakness. Home builders, again, the outlook is still looking fairly dire. Today's move is, again, maybe just a short-term aberration. So maybe we do test the high of the gap day from back here at around 61, but look for home builders to roll over. We're probably looking at them retesting their lows around 51 here over the next coming weeks to months. The trade today on XHB was actually November expiration, so we're out there a little bit. 23,000 contracts buying the 52 and selling the 47. It's a sizable trade, and you're looking at 47 all the way down here. Certainly 51 seems like a reasonable target, and as we're stretching it to 47, just giving it a bit more time for it to happen. And this is kind of what we've seen over the last couple of weeks, right? Some near-term bullishness, but overall, looking by October, November, a bigger pullback in the market. And seasonally, the second half of September into October is a relatively bearish time. Again, what could stave that off in the near term, it all comes down to what Powell says. But as we roll into October and November, that the bullish tenor, if we get it, which should or likely turn more bearish. And again, so we're looking at XHB here. And that's a nice, again, low risk, high reward trade for November. I'm out here that, obviously the spreads have widened out since we're at the close here, but it's not an expensive trade. This case costs about, 70 cents for what, $5 of upside, right? So again, risk 70 cents to make 430. It's a pretty good trade-off for the stock going to 47. You could tighten up that spread if you wanted. On the oil front, so we looked at CL. USO did rally off the lows today. We're going to have inventory report on Wednesday. Again, dovetailing with also, what is the dollar about to do? What does that mean in terms of expectations? Well, for USO, you are seeing a little bit of the tarnish coming on this product with the flattening curve. And today in USO, it was the 66.61. I was looking at earlier. We may have other trade come in here, but 66.61 right here. This is being closed out, or would it be? Looks like it more likely is. This right here, 66.61 is opening because volume is greater than open interest. Again, we're looking at $61 to downside here. What would that mean in terms of forward/CL? I'm suggesting 80 could be a baseline, but that would obviously portend a bigger move, maybe towards 75 in oil, which if we, again, dollar strengthens, we could see a big enough move lower to be able to experience that. Now, we've talked about potentially being long staples. Well, what about cyclicals? Cyclicals had a pretty good day today, but don't mistake what we're seeing in near-term strength with overall changes in the dynamics going forward over the next number of months. Report today read that, Walmart and a lot of retailers are pulling back on orders. Inventory levels are relatively high. I'm not sure that analysts have really cut earnings expectations as much as they're likely going to as we move in towards the end of the year. And then we get our third quarter earnings announcements here coming up in mid-October through mid-November. So for XLY today, it was an October expiration. Again, it's out there a little ways. It was at the 150 strike today. Again, looking at downside here, 150. That's, basically the most recent low. We start to take 150 out. We may see that kind of pick up here as we drive back towards 135. But again, in October expiration, you have some time there for it to get there. You might look for either the stock rallying back up towards 167 and looking to reset there with an in-out spread, or maybe just directionally look for this price to start to break below yesterday's low en route to a retest of the lows at 133. But you can see some early representation stepping in on the bearish side today in XLY. On the metals front, again, materials best performing sector today. It was bullish activity in Alcoa and FCX. FCX gets a nice bullish engulfing pattern. There was bearish activity last week on the 12th. Took it off my top-down Friday watch list, but today's move, very similar to what we saw on the 8th, probably expecting FCX to get back towards $33 again. Now, we look at today's activity. This is going out a bit further out to November at the 35 strike. So again, what happens? This is certainly saying, hey, we're looking at possibility we may see a rally back towards 35. Again, we've seen this kind of trade before, and it's been a struggle. Everything hinges on what the dollar does, but in the near term, could we reach towards 33 in the next couple of days? Absolutely, that's a possibility. Again, the juxtaposition of strong materials but weak financials. Financials did see a good day today, but at the same time, stretching out to December, there is this trade out here at the 30 strike, putting it out there, 30,000 contracts. Again, looking at the possibility of 30. This is something you may look for a trigger. So for example, trading below through today's low, then looking for it to gain steam as we roll towards 30, or at least the most recent lows at 30.5. But in the near term, if we can really push high this week back towards prior highs from 912, it's going to reset as an opportunity for like in and out spread, for example. So while there's been some bullish gold activity, juxtaposition or the opposite is bearish on silver. So we rallied off the low, finished it basically towards Friday's high at this, or Friday's close at the same level. And yet today in silver, a December expiration out here, 20,000 contracts, mostly bought at the 17. Again, what you're seeing in a lot of this is confusion, right? So from my perspective, again, expect to see a little bit of a rally going into the Fed statement. We may stall out if the Fed's dovish. We may see markets rally strongly into the end of the week. But again, being in the more consumer, non-cyclical space does provide some insulation from a potential down move. The bearishness is still there with regards to stronger dollar, higher interest rates, XHB, SLV on the bearish end. Again, weaker dollar, AA, FCX, those stocks could see some near-term strength. So, again, it's really, really hard right now to really get a strong direction, in particular with the Fed statement. And the fact of the matter is, we just didn't really experience that bearish capitulative sell-off that you saw back on the 13th of June. We just haven't seen the kitchen sink being thrown out to really anticipate a major rally. So There was some bullish activity today, like Carvana and GPS and stuff like that. Other ones that, again, do we get the short squeeze? Does that materialize like we saw in July? Look, we got it about a little over a week ago, and it fizzled with Tuesday's CPI report. Really hard to go back to the well again unless we really stretch, but that Wednesday statement could really muck things up for otherwise a bullish setup from an oversold position. So again, just be careful this week. Look forward to the Fed statement, and we'll see where we go, but certainly positioning more in the near term here, more defensively, may not be a bad scenario. Even utility stocks like a Nextera, for example, could create some near-term bullishness going to that statement. All right, folks, we got to wrap it up there. Hope you have a great one. We'll see you back for